Thank you very much for inviting me. It's quite an honor to speak in front of so many people. So I was asked to talk a little bit about status and outlook of European venture capital industry. It's probably the topic I know most about because I've spent 18 years, my last 18 years in that industry, day and night more or less. So I hope that if anything I know about this topic a little bit. So let me try to share my perspective on it. Please interrupt me if you have questions or want to go a little bit more into depth in certain topics. Happy to do a more dialogue style. Usually it doesn't work, but so don't be shy. I'm happy if I get questions. Yeah, what is the fundamental driving force which is behind the outlook, status and outlook of European venture capital industry? Actually, it's the advent of the internet. The ubiquitous availability of online, of web connectivity does change the world. It does create an economic platform containing more than 3 billion people right now. Tomorrow it's going to be the entire mankind, which will be online. This is something unparalleled. It never was the case in history. And it provides a platform where an entrepreneur, and this is where venture capital at the end of the day comes into play, where an entrepreneur can reach the world. Out of Schwabing, Stockholm, Los Angeles, New York, Shanghai, nobody cares. You can reach the world. No, it's not about some trade agreements, negotiations, Zollabkommen, whatever. It doesn't really matter anymore. That is the global economic platform which is open and available for everybody. That really changes the world. And it's only available since a couple of years. It's relatively new. At the same point of time, you know, the hurdles, the prerequisites to participate in this huge economic room have melted away. In the meantime, one can set up, as you probably all know, a pretty decent e-commerce site for less than 5,000 euros. A much, much worse e-commerce site has cost us a couple of millions just 15 years ago. I know what I'm talking about. We did that and we funded it. At the same point of time, when we funded shitty e-commerce sites, there were hardly a couple of 100 million being online, and they were hardly willing to pay online or to spend money there or to really use it because they were afraid and not used to, etc. So the situation has changed in many dimensions. It is an unparalleled opportunity for entrepreneurs what we never had before. So the bad news and the flip side of this development is there's basically no place to hide in the internet. So the traditional entrepreneurial approach that we had in the past, you know, I'm creating something for Bavaria and then probably for South Germany, then for the entire of Germany, and then for the DACH region, and then West Europe, and maybe if we conquer that, we go to entire Europe, and at the very, very end, we think about the US. That doesn't work. So if we come up in the internet with a great innovation, with a great idea, you can be sure it's going to be discovered by the world, throughout the world, pretty quickly. And unless you manage to really scale it quickly and become a global category leader, you're going to be overtaken by your own idea by somebody else from Shanghai, LA, or wherever. So at the end of the day, what I'm saying is, it is more and more a winner-takes-all game, and you're in fierce competition, and you have to be quick, and that costs more money than we used to spend in earlier days for the scaling and for the marketing. Sorry, that was a question.
Yes, you just concentrate on the business.
No, but to be honest, we concentrate on IT and health tech, so I'm not so much in health tech. That's the reason why I'm talking more about IT, and IT without internet is not in existence anymore. So each and every IT deal is somehow related to internet. And what really made IT different than from the past is the internet. If you think about cloud computing, the basis for that is internet. That's why I'm highlighting that development so much, because I think this is the true disruption, the true difference from what we had in the past. To take my words, massive disruption is going on. There are many examples. I can come up with tons of these slides. If you go internet traffic, whatever you look at, and you're aware of these slides, it is just amazing if you look at the sheer numbers and the speed of change we experience in that regard. However, and this is a very important message I'd like to convey here. However, we're not even scratching the surface seriously with that new development. If you think about, and this is the chart about, if you think about probably the most advanced economy of the world with respect to digitalization, the most technology savvy country in the world, where you have probably the best internet penetration, I'm talking about the US in this case, we're only having a sub 10%, 7-8% percentage of e-commerce revenues of total retail. That is nothing. I mean, and e-commerce is probably the most obvious and the most immediate space where you move into if you start a digital business, because it is so trivial. So even in e-commerce, in the most advanced society with respect to digitalization in the world, we are sub 10% in that regard. I think we can quickly agree that this development will not end at 15%. It will also not end at 30%. Will it end at 50? I doubt it. Probably it's going to be 70 or more over time. And this is, again, in the most trivial application of the internet one can think of. Now think about more advanced applications. I mean, one thing what is talked about right now quite a bit is fintech. Think about, innovations in finance, financial technologies, the bank of the future, in Industry 4.0, enterprise internet. There are so many fields where the penetration and the sophistication of internet businesses, new internet businesses, are way behind what we see in e-commerce. And in e-commerce, it's below 10%. It's unbelievable. We're only scratching the surface. It is the very, very, very beginning of a multi-decade development in this new fantastic economic room of basically the globe. Something has changed, and now I'm trying to switch over to Europe. Let me make a following comment. In the past decade, between 2000 and 2010, the yield of significant European venture-backed startups are pretty sad, to be honest. We, as venture capitalists, are used to talk about unicorns. What is a unicorn? A unicorn is a company which has surpassed $1 billion market capitalization. Unfortunately, in the last decade, between 2000 and 2010, there were only 3 unicorns being breeded out from the European VC industry. It was Skype, MySQL, and Autonomy. Only 3 in a decade. In the same point of time, the same period of time, in the US, we had 4 per year, 40 over 10 years. By the way, same GDP. Yeah? So we're not talking about size differences. Same GDP. I would argue relatively comparable technological base. But on the one side of the Atlantic, we had 3, and the other side of the Atlantic, we had 40. If I now change the time frame, the time period, and look at what has happened between 2011-14, it is striking to see that in Europe we have already seen 24 unicorns being created out of European venture capital industry. Interesting, right? It's in the same point of time, the US productivity has not gone down, but it hasn't been increased significantly. So it's what we see is Europe is catching up. Why is it so? My explanation for that is that with the ubiquitous advent of the internet, for the first time in mankind, the inherent disadvantages of European tech startups being confronted with an extremely fragmented, smallish home market, where you have to conquer after Denmark, Germany, France, UK, I don't know what, with different legislation, different languages, different costs and risks to scale businesses. And for the first time ever, that inherent disadvantages has been overcome by the internet, which creates much more a level playing field for everybody, regardless whether you're sitting in San Francisco or Schwabing. And because of this difference, we now see a much higher yield of significant companies being created in Europe. I'm saying this to encourage you, the odds are much better than they used to be. Now is the time, probably much more than ever. By the way, there are 4 German companies within this list. There's another good message with respect to the European VC industry. That's a relatively uncommon view on the industry. What we have done here is we have basically ring-fenced the European VC industry each and every year, and we have looked at the cash flows going into that industry and coming out of that. So what is the amount of euros being invested into the VC industry, and what is the amount of euros which has been distributed from that industry to its investors? I have consciously cut off the time period before 2008 because they were embarrassingly negative. So I rather do not distribute these numbers further. Also, sorry, that's the wrong. Sorry, I'm talking about the wrong chart. So this is the chart I wanted to talk about. I go back to the other one. I'm sorry. So this is the chart. So I've cut off the time before 2006 because they were negative. And what you see is the European VC industry has started to produce cash. First time 2011, but in the last year quite significantly. If you compare that to the total investment of within the European venture industry, it's quite significant. We're investing in roughly 3.5 billion euros annually in Europe. 2014 there were 8.3 billion distributed. So the industry has created almost 2.5 times as much cash as it's been invested. This is quite significant, relatively good yield. That's admittedly the first time since 2000. But it is a good sign that something has changed. So why did that happen? Now I go back to this one. One of the reasons is the exit markets, which are extremely important for us when it is about to sell companies or to bring them public and to translate shares what we own into cash again. These exit markets have reopened. And we see 2014 was a long time high with respect to number of venture-backed IPOs, 170 globally. And what is interesting here is that the share of the European companies has increased quite significantly. It has used to be just around 20% of total VC-backed exits. Last year, for the first time ever, it's been 50%. So again, my message is Europe is catching up. So that wrong direction. So is this the year 2000? So are we approaching again another burst of the bubble, what we experienced in March 2000? My belief is no, we're not. If you look at the numbers, first of all, KPIs are much more profound than they used to be back in 2000. Companies are significantly older, which are brought public. They're on an average much higher revenue level. Their valuation multiples are by far much more conservative. Even more importantly than these KPIs, I think, is the difference in the underlying business opportunity. We're on average talking about companies addressing the global market. Yeah, we're talking about, if I take, one word from the year 2000, we're talking about 3 billion or 3.5 billion eyeballs. And we actually about 7 billion eyeballs, to be honest. But this is something which is really different. Because at that point of time, back in the year 2000, we had 100 million people online, and these 100 million people online were only on a mediocre level willing to spend money and use the internet for true transactions and businesses. That has entirely changed. So the underlying business opportunity is huge, much bigger than they ever been. However, this huge opportunity which I'm painting here has not yet been reflected in respective funding or respective growth of the industry I'm talking about. It's not been reflected by the European venture industry. If you look at the light blue columns, that's the number I was mentioning beforehand. Something between 3 and 3.5 billion euros is being invested throughout Europe in venture capital each and every year. And that compares to 22 billion euros being invested in the US. And again, to remind you, same GDP. I have not mentioned the year 2014 because that would make us extremely sad, because in that year the US venture capital investment last year have almost doubled, whereas European venture capital investments went straight again. So while we have here a factor 7 to 8 in the year 2013, this factor of penetration has doubled in 2014. So now we have per capita a difference of almost a factor 15 between what is invested in venture capital in the US and what is invested in Europe. This is another 20-minute discourse because, like in many cases, there are a lot of reasons. To cut it short, first of all, European venture industry has only been created back in the late 90s, whereas the US venture industry has a 35-year history. That is a problem because after the late 90s, we ran through the burst of the bubble, and the very young VC industry had negative returns in the very first funds. The typical reaction of an investor is not to throw good money after bad. So if they have lost once with a certain venture manager, the typical reaction is to withdraw and not to grant the money again. So what happened is, in Germany we had in the year 2000 107 registered venture capital firms, out of which 2 have survived. EARLYBIRD is one of the 2. In the meantime, we have a couple of new foundations. There are between 10 and 15 active investors, but 10 and 15 for a GDP which represents 25% of the US GDP, and the US has 500 active VC investors. Another reason is 2/3 of the US venture money which is invested into the funds is coming from pension plans and endowment funds. That is an asset class or an investor class which hardly exists in Europe, at least not in Germany, since we have a different pension system. On the other hand side, we need extreme patient money for our funds, because our funds typically, we say they run 10 to 12 years. In reality, they rather run 15 years. And there are not very many investors who are willing to, to illiquidly commit their money over such a long period of time. Pension plans are, endowments are. So that's just a couple of more reasons, but this is one of the reasons why the European venture industry up to now is so weak. Another reason is that the underlying exits weren't as good. I mean, the 3 billion, the 3 unicorns only in the last decade is obviously something which is not good for returns, as opposed to 40. And the money is following the returns. By the way, but the last decade, the US returns haven't been much better than the European ones in venture capital, so we're pretty comparable. However, my message here is great opportunity, better than ever, especially since the last couple of years, but this opportunity not yet reflected in the funds invested. Let me do one more excursus. That is, if you look at it, from the overall economy perspective, this is extremely sad, because we just have to consider that Germany alone is investing about 50 billion euro each and every year in some form of technology support. From Exzellenz University, Technische Universität München, to Max Planck, Fraunhofer, R&D subsidies, etc. And that all sums up to 50 billion each and every year. I mean, this is not just invested because we like technology so much, because it's invested because we believe that technology anything what I can do here? Okay. Represents an important prerequisite for future wealth and jobs. But this is only the case if we are able to translate pure technology, if you want patents, into companies which then employ people and create wealth for the economy. And the entire system is only as good as the weakest element. So if we're investing 50 billion in the creation of new technologies, and we only invest $500 million, which is the true number for Germany, into the commercialization of the 50 billion technologies, that is just stupid. It's just crazy. Yeah, because we have a huge wave of patents and new technologies approaching a very tiny little hole through which each and every technology has to go, which is commercialization funding, in order to create real companies. So the immediate reaction would be, why don't we reallocate 1 or 2 billion to the commercialization phase in order to triple or quadruple the output, total output, without spending any additional euro? Not happening yet. Interesting, if we look now, so there's a question. Yeah? The 50 billion is invested largely, it's public money. It's in the public budget for, as I said, Exzellenz University, support of Fraunhofer Gesellschaft, etc. Plus the privately funded R&D efforts in these institutions. Plus, what is publicly funded as R&D support to private companies. If I now look at the European 3.4 billion in 2013 and look at the substructure and look in what stage this money is invested, there's an interesting observation, and that is that in the meantime we still have a relatively liquid market in the very early stage of venture funding. So I'm talking about the light blue and the dark blue parts of the columns, which is seed stage and startup or the early stage. Whereas after Lehman in 2008, we had an implosion of the growth funding. So when it comes to not something like 1 to 3 million, but rather 10 to 20 million funding of companies which already have passed some sort of proof of concept. So the scaling of credible ideas has dried out, or the money to fund the scaling. One can perfectly discuss why that happened. There are many explanations around. I do not have any scientific explanation for that. At least it is a fact and an observation that in the current status of the European venture industry, we still have relatively good availability in the very early stage, but it gets extremely hard to get significant amounts of money to make companies really big. Things like we frequently see in the US, where we see Series B and C funding with 30 million, 50 million. I mean, if you talk about Uber and things like that, we talk even about billions. That is absolutely unthinkable in Europe. There's no funds, respective funds available, and that is a problem for European startups if they really want to compete on the global scale, what they have to. That must be my introductory comment. So this is, again, a summary of what I already said. Relatively good liquidity of the market in the seed stage, but venture growth is the true the true bottleneck right now. If I look through the system, mature growth is again very good because at that stage companies are so proven that they can easily access international capital markets, and then again it's same level playing field for everybody, regardless whether the company is originated in Europe or in the US. So this good opportunity, because if you flip that around, scarcity of money, it's always about supply and demand, represents usually a good opportunity for investments of investors, for venture capital firms. That has been discovered by the most relevant US investors. It's interesting to see that not, the tail end or the long tail of US VCs are coming to Europe in order to make good investments here. It's actually the top league, the very top, I don't know, it's called the golden circle of the very best 20 venture firms from the US. They're coming to Europe in order to allocate their money because they believe that they find even better investment opportunities than they find in the US. And in the US, they have access to the very best opportunities over there. I think this is an impressive proof of the hypothesis that right now, both for the entrepreneurs but also for venture investors, outlook in Europe is pretty positive. So with that, I'd like to close my little speech, and this is nothing else than a quick summary of what I've said. You probably want to read it. I don't need to read it for you. Thank you very much for listening, and happy to answer questions. I see one over there already.